Stop recording. So the recording is happening. Okay. So we'll see what the problem is here. Okay, so let's try and the recording is happening. So let's try and let me try to write down whatever I can here. Okay, so that we can at least make some use of the session, and later on I'll try to take an extra class. The pricing of floating rate debt securities. All right, so pricing of floating rate debt security. Floating rate means essentially the interest rate is reset. Okay. To floating rate benchmarks, mainly LIBOR. Okay. And I'll give you some optional material here. There seems to be a real problem with the network today. So let me see if there's any. Are you able to hear me now, Mayank?
Yes, sir. Your voice is audible.
Responding. Yeah, you can hear me, right? I think you were responding, but then again, my
in between your voice has gone.
etc. that I've discussed above. Okay, that relates explicitly and directly to the pricing of debt securities, whereas this floating rate bonds, floating rate notes, actually, floating rate debt securities, they are priced against floating rate benchmarks, which are mainly LIBOR. It's not really a government, not a government rate. Okay. Okay, so this I'm not going into the details of. Not a government benchmark. LIBOR is not a government benchmark. You need to do some studies on LIBOR to understand what it is. So LIBOR is a floating rate benchmark, and floating rate essentially means that a floating interest rate means it's reset several times during the tenor of the loan. Floating interest rate means that I'm not even able to actually get, the network is so bad that I'm not even able to get a response. I can see that Mayank is trying to respond, but let's try that once again. Can you hear me, Mayank?
Yes, sir. You are audible. You are
okay.
audible.
As the net screen is showing.
Sir, it is actually coming and going. Right now, it has again gone. So,
Okay.
It is visible to us.
Sir, it is visible. Sir,
Yes,
it is-
sir.
Okay.
Screen has
Okay.
not.
But your voice is breaking
Yes,
in
sir.
between, sir.
Okay.
Yes.
Okay. All right. So let's see what we can, the best we can do under the circumstances, because I don't want to just give up like that. So we'll see whatever best can be done. Okay. So in any case, the note, I'm writing the note. So what I'm going to do as my backup plan is that I'm at least writing the notes. So which means that I will write the notes in a more explicit way today, so that, and you guys can access the notes. So at least you will know what is being discussed, and we have a clear marking So we will not just give up like that. We will try to salvage whatever we can out of the session. Okay. So it's I think it's mainly my network which is causing the problem. The floating interest rate is what Mayank was defining is not exactly correct. The way you have to think about a floating interest rate is that it is the I'm writing this for interest rate. Okay, is reset more than once during the tenor of the loan. At least I have the satisfaction that if I write it clearly in the notes, you can access the notes and you can cover the material. Okay. Yeah. Okay. It keeps knocking me out. Okay. So let's see here. Now, the pricing of floating rate discussion, this is the subtopic. And so I said that the above discussion, which is the government bond benchmarks, pertains to the pricing of fixed rate debt securities. In the pricing of floating rate debt security, the benchmark is actually LIBOR. Okay. So the benchmark becomes LIBOR, which is not a government benchmark. But there is a way to connect that, but for between make the connection between LIBOR and the government bond yields, the government debt security yields. So we'll discuss that. But here, what it is the floating interest rate. First, we want to make sure we understand what is meant by a floating interest rate. The very simple definition, once again, is it's very precise. A floating interest rate is any kind of a floating interest rate loan is any kind of loan on which the interest rate is reset more than once during the tenor of the loan. Okay. So, for instance, if you take a student loan and they have set, say, 18% for the student loan, now you may be repaying the student loan over 5 years, but the interest rate is never going to change. Once they set the interest rate at the beginning of the period as 18%, over the 5 year period, you will be paying at the rate of 18%. Whatever happens to market interest rates, that is no concern of yours because your rate has already been fixed. A floating rate is a slightly different concept. I don't want to know whether if I should, let me just try that. Okay. But the floating rate is a different concept. It's, let me see here if I can get LIBOR rates. 3 month LIBOR, which is very, very mainstream actually. All right. So we'll just put this here. I'll put the I'll put the example as here, and we'll write the 3 month London interbank offer rate. This also gives you the expansion of LIBOR. What exactly does LIBOR mean? And let's have a look at the rate. I hope you can see the screen, but otherwise you can just click on the thing later on. Okay, so we are talking about this over here right now. Floating interest rate, the 3 month interbank LIBOR rate. This is the most common form of LIBOR, and the LIBOR is set for different maturities. Okay, let's do max and see. Yeah, you can see how it has moved. Okay, I might have shown you this chart once before. 3 month London interbank 3 month LIBOR. This is the most common benchmark for all floating rate loans that are outstanding. Okay, there is a transition happening away from LIBOR, but the historical baggage cannot be overlooked. There's a massive amount of trillions of dollars of debt securities and derivatives on debt securities are outstanding, all with a reference of LIBOR. Now, 3 month London, if you take a loan at 3 month LIBOR with a benchmark of 3 month LIBOR, and the loan is for 5 years, what that means is what is it that makes LIBOR a floating rate? Because you got a 5 year loan right? That is set at the beginning of the loan. But every 3 months the rate is going to change, and you can see how much it varies. Okay, right now here, what else am I going to write? In order to make the connection between uh, between LIBOR and and yeah. So what I'm writing is that in order to make the connection between LIBOR and government bond YTM benchmarks, we need to refer to the market for yeah.
So your voice is breaking a lot.
If you can maybe open the notes file from your side, like Mayank has opened, then maybe you can follow it a little easier, or you can at least open it later. And yeah, this is the voice is breaking because it keeps knocking me out of the meeting. So I don't know why it's doing that, because I've tested, I was able to do YouTube video streaming, and this meeting has no videos actually. So I don't know why this is happening. But anyway, we'll try to investigate. Let's try to make the most of the session today.
So maybe you can try
So in
rejoin the
order to
Zoom
make the
call.
connection between, sorry, come again.
So you can rejoin the Teams
Rejoin.
call.
Okay, you're suggesting that if I disconnect and rejoin, it'll be better.
Yes, sir. It might be.
Okay, but I think it'll in. Okay, so let's give it a shot once, but then we'll have to record it again. Okay, if I disconnect, we don't need to stop the recording, right? I will just leave, and
No, sir. It
if
will
I hang
continue.
up, it will continue. So if I just hang up, you're saying I should just hang up and then rejoin.
Yes, sir. Not
Is that
exit
what you're saying? I've never
exit the
done this
meeting. Just
before.
leave the meeting. Not exit the whole meeting. Just leave the meeting, sir.
Okay, not exit the meeting, but if I should I click hang up first?
No, sir. Just leave the meeting, sir. Normally, not exit the whole meeting.
So simply change your Wi-Fi connection. No need to like drop the call.
I think the best way to do this is let's just put up with this, because I don't think if the connection quality is poor, it's not, because anyway it's knocking me out and re-logging me in. So if the connection quality is poor, it's
So,
going to.
excuse me, sir. So simply just change the Wi-Fi connection if possible.
Yeah, go ahead, Aditya.
Sir, I'm saying simply change the Wi-Fi connection if possible.
So switch to your mobile data.
Okay, so let's see what we can do here. I'm writing the notes in detail, so you will be able to follow the notes at least later. Let's Yeah, I got your message, Aditya, but I don't have that option at this point of time. So that's we can't follow that. So let's try and do this. Let's try and make the most of this. I'm writing the notes clearly so that you'll be able to make out later on. Okay, when you read the notes. So okay. So the other point that we have to worry about, because we talked about government bond benchmarks being the main reference point for debt security pricing. So we have to make the connection between LIBOR and government bond benchmarks. So what we need to do, we're not going to do that, but I'm just giving you some basic information that in order to do that, make that connection, we have to refer to the market for interest rate swaps. Okay, so this is not going to be. This will be another. This is outside the scope. Okay, so hence uh, this is this will not be covered now. So the reason I told you all this and told you why I'm not going to cover it and what I'm not going to cover is just you need to be aware that the pricing of floating rate securities is slightly different. Okay, the concept remains the same that there's a benchmark and then there's a credit spread, but the benchmark changes in the case of floating rate debt securities, and it is done mainly with reference to LIBOR, which is not a government bond benchmark. And in order to make the connection between the government bond benchmark and LIBOR, we need to refer to the market for interest rate swaps, which we are not covering now. Okay, this is normally covered in FDRM. We can't afford to cover it now because this is a massive topic. So we just cannot afford to cover it now. But I just this yeah. That the floating rate debt securities are priced with. Yeah. The other thing. Okay, all right. So this is as far as we discuss on debt securities. I just wanted to give you this little module on floating rate debt securities so that you're aware. And then I've given you some optional material here if you want to read, because there is a transition happening. The transition from LIBOR is also happening because there was a scandal and during the around the time of the financial crisis. That so this is also very important for you to read as finance students. It's not part of your syllabus, but I'm giving you some material that you might want to read as to what happened in the case of LIBOR. There was a rate rigging scandal during the time of the financial crisis, and because of that, the market is slowly transitioning away from LIBOR, but the overhang of LIBOR, because we've been using LIBOR since the late 1970s. So there's a massive amount of historical, securities, historically issued securities based on LIBOR. So that overhang is not going to be easy to get rid of, but the transition is also happening. So you should be aware of a few things, that there is a pricing of floating rate debt securities, which happens with reference mainly to floating rate benchmarks, which historically has been mainly LIBOR. And then that, what is the definition of a floating rate? And then the connection between LIBOR and government bond benchmarks requires a reference to interest rate swaps, which we are not studying right now. And then you have the LIBOR rate rigging scandal and the transition from LIBOR. The last two. Yeah. So the last two parts are optional for you. This LIBOR rate rigging scandal and the transition from LIBOR. This you can do. This is for your own benefit as finance students. You need to know all this. So I'm putting this, I'm giving you some resources. Please refer to them. And so I'm making this part optional. Right. We will now move on. So that finishes our coverage of debt markets. So I wanted to give you some basic understanding of debt markets and how they work, so that we can, so because you need to have that knowledge as finance students. Let me close this, maybe. All right. So, okay, let's look at the book now. Let's look at where we were, page 22. The entire discussion is based on page 22. Is sharing the screen, hide it. Okay. Now, page 23 of the book. Okay, so on page 23, the first, you can see what he's saying here. He's trying to give you a plan for a strategy for investing in common stocks. And here there's an expression that he has used which requires a little bit of clarification. Here it says that chief requirement is the readers limit themselves to issues selling not far above their tangible asset value. Now, can anyone tell me what is meant by tangible asset value? Although we are having trouble with the network, let's try to see if we can hear anybody's response. Tangible asset value, anybody has an idea what that means? Normal asset value, we understand, right? We look at the balance sheet size, and that's the value of your assets and the value of liabilities. So the asset value. Yeah. Anybody has an idea on what is meant by tangible asset value?
Sir, in this
Okay.
we take into account tangible assets only and not intangible assets.
What are intangible assets?
Sir, like patents,
Give me.
goodwill, which cannot be touched or felt, and tangible are like land and building,
Got it. Okay.
machinery.
Yeah, you're right. You're right. Okay. Now, what is goodwill? You use goodwill. What is goodwill? I'm writing here.
Intangible asset.
Market
No,
reputation.
goodwill isn't. No. So that definition of goodwill. Remember, 1 minute. So let me write down. Okay. So we'll just pause the inputs at this point. Now let me make some comments on what has been said. Okay. So first, Mayank is correct that tangible asset means leaving out intangible assets. Okay. So what are intangible assets? Intangible assets, as he said, is goodwill. We said patents, so we will write IPR related assets. Okay. IPR stands for intellectual property rights. Okay, so that's a more general term because you could have certain copyrights, because in software in the US you have copyright license, copyright law that applies, not patent law. So a more general term to instead of saying patents, which is very specific, patents doesn't apply to copyright. So IPR will be much more general, intellectual property rights related assets. So that will cover patents and copyrights. All right. And so that's basically what it is. So tangible asset value means, so we say we write down these definitions so that these are there for your reference. At least good. At least I'm good that I could hear a couple of responses clearly without. I mean, the connection is not a total disaster, but it's really bad actually. So tangible asset value is leaving out intangible assets. So you take the entire balance sheet asset size, but you leave out the intangible assets. Okay, so if you leave out intangible assets, what are intangible assets? We need to define that. We've already got the definition. That is, intangible assets are goodwill, IPR related assets. Okay, now coming to the definition of goodwill, you have to understand this as business students. The term goodwill is used in two different, spelling is not correct, contexts. One is a marketing context. Okay. In the marketing context, goodwill refers to market reputation, as was mentioned. Okay, market reputation, etc. Okay. Okay, market reputation. All right. So market reputation is, this is in the marketing context. But when we are talking about balance sheets and we are talking about tangible assets and intangible assets, this goodwill that Mayank mentioned, this goodwill is now, he's talking from a different context, which is a different, you have to be aware. So but when somebody asks you in an interview, what is goodwill? So you have to ask them another question. Do you mean goodwill from an accounting point of view, or do you mean goodwill from a marketing point of view? All right. Now I'm talking about the accounting context. In the accounting context, the marketing context, goodwill is, this is what we most of us really understand. It's a little bit loose. This concept is a little bit more warm and fuzzy. It's not so precise. But the accounting definition of goodwill in the accounting context, goodwill has a very precise meaning. Okay, refers to excess of price paid. There's no reputation here. Excess of price. Okay.
So you are not audible.
Yeah, I'm not saying anything right now. I'm just writing. That's yeah. I'm just not. I'm not saying anything. I'm just writing. So now I'm audible.
Yes, sir.
Okay, good. So the other question I have is, I'm very concerned about this network quality. The other question I have is, I can see myself getting kicked out of the room repeatedly, but when I come back, So when I come back and you can actually see the screen and you can hear my voice. At least that is working. So when it's showing me that there is no issue, at least then we know that you're able to see. But some people are not able to see the screen sometimes. That's the other problem we need to sort out. Yeah. See, just knocked me out for a few seconds. Just knocked me out for a few seconds. Okay. So fair market value of that asset is, I don't know if you can see the screen. I've given an example. So in the accounting context, goodwill refers to a very specific thing. It's a mathematically definable concept. It refers to whatever is the excess of the price you paid for an asset. You, in this case, is the company, over the what is the excess over the fair market value of that asset. Remember, the accountants are going to do a fair market value when they put the assets on the book of the acquiring company. Typically, this happens because of M&A transactions, acquisitions. So you pay a certain amount of, so you pay, let's say you pay $30 billion to buy a company. So like recently, for instance, Slack, Salesforce has bought Slack. Slack is a kind of an email messaging app, and that's been bought by Salesforce. So Salesforce, I don't remember what exactly they paid, but it was quite a good heavy price. So now whatever they've said, let's assume they paid 30 billion, and let's say that the accountants of Salesforce all right. So the so and okay, earlier because you paid 30 billion for a company which is worth only 23 billion according to the accountants. So you've got 7 billion of goodwill, and that sits on your books. It's an intangible asset, and it is subject to periodic impairment tests. And this can have an impact. As an equity analyst. You need to be aware of this, because this can sometimes, if there is an impairment detected, if the accountants say that your goodwill is impaired, you need to write it down. So this is, you have to write down the value of this asset. So you'll have to credit this balance. Okay, suppose there's a $2 billion impairment. Okay, if there is a $2 billion impairment, then you will have to credit the goodwill balance by 2 billion. Okay, so that will bring down the value of the goodwill to 5 billion, and the corresponding debit goes to the P&L. Okay, so you will take a loss in that period due to goodwill impairment. So you have to understand this can have a huge impact. Recently, if you remember, Warren Buffett also was, since we are studying value investing, it's a topical example. Warren Buffett had invested in Kraft Heinz, and I don't remember which. There was another company which had bought. I get confused with the names of the companies now. who bought who. But anyway, so uh, Buffett has actually invested in Kraft Heinz, and the um, or actually it was Kraft which bought H.A. Heinz. Okay, so the purchase price of Heinz was too much, and so you can just look this up. The story: Warren Buffett, goodwill impairment, and H.A. Heinz, the loss because of that. So even Buffett got fooled by this. He had bought a company which it bought overpaid for an acquisition, and then got hit by a massive loss. The loss was pretty big actually, 9 to 11 billion, some $9 billion or something like that in one accounting year. So it was a very big loss, and it was quite an embarrassment for Warren Buffett. And since we are studying a book based on value investing, focused on value investing, it's a useful example to look up. So you can look that up. I'll give you that example here. Um, I'll just write Buffett, make the connection, Kraft Heinz. Just look up, if you just do a search on Buffett, Kraft Heinz, impairment loss, goodwill impairment loss, you'll see that. Okay, so they basically overpaid for the company. So this is a really big problem in the M&A space. You overpay for the company, and then sometimes you might have to write down the value of the goodwill, and that leads to a massive loss in that particular accounting year. Right. So this is an important thing to learn, that goodwill has two different connotations depending. So what do we learn just now? We talked about tangible asset value. They said basically, what are they saying in the book? They're saying that, let's close all this so that there's no traffic from those sites. And this also can be closed. All right. So you've learned tangible asset value, and what they're saying is you should not buy anything far above its tangible asset value. So you should try to buy common stocks which are trading at close to their tangible asset value. So that leads to the question of what is tangible asset value? Anything which you leave out the intangible assets. And then what are intangible assets? Goodwill and IPR related assets. That is both patents and copyrights. So recently, I've given you an example of HCL Tech buying a bunch of licenses from IBM. Those will be IPR-related assets. Okay. So goodwill is used in two different contexts, and that's the other thing. That is the marketing context, which is like the reputation that the firm has, etc. And then you have the more precise and more important accounting context, which is a very precise definition of what is the excess that you paid over the fair market value of the firm in doing an acquisition. And then the excess is basically written down, is kept on the books as goodwill, and may have to be written down from time to time based on impairment tests, right? So this is an example. You can look up this example. All right. So we move on in the book to anything else that we need to cover. We need to annotate. These are all annotations that are happening as we follow the text. We try to annotate, and wherever there's important material that people need to know, I spend a lot of time annotating, which I did in the case of debt markets, because these are things that you need to know. So, yes, Mayank?
Sir, why we this okay that we are reducing the goodwill because it is type of it can be impaired, but why we are reducing intellectual property rights assets also, because those are something which has come, which is like company has not overpaid for it or something. It's something which they have invested in because of their R&D and everything, and that's why they are getting the return out of. They will be getting the return out of it. So shouldn't it be included IPRs?
Yeah, I heard some. Yeah, Mayank, I could not hear your full question. I heard a little bit of it. Could you just try to repeat it once again?
Yes, sir. So in short, like why we are reducing IPRs also from the means fair value of the company. If we are estimating the fair value of company, why we are reducing IPRs from it? Because IPRs are something which company has generated because of its hard work and because of its R&D. So that would should be considered an asset only, na?
Yeah, but I mean, the tradition is basically that all intangible assets, those are basically yeah. The question is the
Sir, your voice is going in between.
yeah. So yeah. So Mike's point is correct. Yeah, very often you will find in accounting rules that they fail to take care of the economic value of assets or the economic true economic nature of transactions. This is one of the problems with accounting, which is which comes up from time to time. So this is basically there's no satisfactory answer. Mayank is basically correct, but the real problem with this is the inadequacy of the accounting rules. So what I have discussed with you is the goodwill treatment of goodwill under accounting rules. Does this make sense, Mayank? Does it help in any way?
Yes, sir. Okay.
Yeah. So your point is correct, but this is the problem with accounting. Accounting is that's why we have another kind of accounting, which is basically trying to account for the economic value of assets. So, for instance, accounting doesn't even account for the if you take your argument further, the all the training and development that you put into your employees, where that obviously has a value. Where is that being shown? That's not shown anywhere on the balance sheet. So, in many ways, if you look at accounting rules, it's a very important question that you've raised because you've raised an important issue, which is that the accounting rules. It's a actual problem in the real world that the accounting rules do not really uh, talk about economic values of assets and liabilities. So that is a shortcoming of the accounting rules. But because it's so important to have some proper reporting and yeah, yeah. So we follow the accounting rules, even though they are not, perfect when it comes to truly reflecting the economic values of assets and liabilities. So this is the answer to the clarification for what Mayank said. Okay. Okay. I think every time it knocks me out, it keeps showing this hide option. Endless numbers of. Okay. I think I won't even bother with that anymore. Let's just go on to. Okay, so we understand this tangible asset value. Now, tangible asset value, this is an important aspect. This is in many ways this is a very central concept in value investing. So make sure you understand it. There's an asterisk here, there's a footnote here, and that footnote is referring you to another footnote on page 198. Okay, so you have to adjust this because this is a book page number and we are dealing with the meta page numbers. I mean, I always refer by meta page numbers. So you have to make the necessary adjustment. And so there is another essentially, okay, here, as you can see here, as Kamayank has pointed out, that not included brands, copyrights, patents, franchises. And this can have a very big impact, actually. For instance, if you look at Walt Disney as an example, it's a very famous company, very well known, big, powerful company. Walt Disney, if you do an analysis, it's not, I haven't given Walt Disney to any of the groups, but if you look at Walt Disney just as a matter of curiosity, if you strip out their intangible assets, you will find that they have very little left. Most of their assets are actually intangible assets because they have all these, copyrights in all these pictures, all these movies, and things like that. So all the stuff that they've created. So most of the Walt Disney's assets are actually intangible. So if you strip out the intangible assets, you have hardly anything left. So you can do this analysis. Please make sure you read this footnote. This is an important aspect of value investing, an important concept in value investing. Okay, so this. All right, so here we are talking about in 23 and 24, actually. I've given the page 24 as a reference, but in 23 already he starts talking about. So what he's saying here is basically that just try to buy books, just try to buy stocks which are trading close to their tangible asset value or yeah. So what the Graham is recommending is that you buy stocks which are trading close to their tangible asset value or preferably far below the tangible asset value, and then you can then you have basically a margin of safety. So this is what he's recommending, that this is what you should follow. All right, and what he's saying is that, so he's given some examples here. Uh, it's basically saying that you don't need a lot of very fancy analysis or anything, just a little common sense. And then you can basically equal the performance of the market averages. On the other hand, you could actually try and see if you can do, if you try to put in a little more effort and try to beat the averages, then that becomes, a little bit more dicey because that's what he's saying. Okay. So that this basically, if you see with all their experienced personnel, majority of the investment funds have not really performed very well when it comes to beating the market. Here we're talking about the general market, means a broad index like the BSE 200 or the Nasdaq 100 or the S&P 500, etc. So generally, this is one of the problems in the asset management industry. You'll find that there is a lot of that there are a lot of complaints about how most of the funds are not able to beat the market or beat the market averages. But we're talking about, when we say beat the market, here that I've mentioned this. This is an important point. To beating the averages or not. Averages means key market indices used as benchmarks. Okay, so we already encountered this topic once when we talked about benchmarks, that the benchmarks are usually the key market indices, which have to be appropriate to the type of mandate that the fund has. So if you're running a technology fund, your benchmark cannot be the Russell 2000 because that's a small cap benchmark. So if you're running a technology fund in the US, US focused technology fund, then the right benchmark is the NASDAQ 100. All right. So this is basically what is meant by the appropriate benchmark. So everybody is always concerned about whether you're beating your benchmark or not. And beating the averages basically is referring to beating the benchmarks. So this is a key focus in fund management. I just want to highlight this, that whenever you're looking at the analysis of whenever you're looking at the analysis of any fund's performance, then this becomes a key focus. The first thing you look at is one of the first things you look at is how did this fund do relative to its benchmark, and did it beat the benchmark or did it beat the market? So usually we say that this beating the market, right? So this is a key focus in fund management. So we have to be aware of this, and he's talked about it. And generally, many of the funds don't beat the market. Right. Now here we have, okay, this is basically the same thing he's talking about, how difficult it is to beat the market, etc. Right. Let's see. It's a very difficult job to beat the market. That's why he's suggesting that you have a strong-minded approach. That means basically stick to your plan, and based on this margin of safety. There's another important thing that you need to know, which is wealth management versus asset management. What is he talking about? Why am I making this comment or this annotation? You see, this is there in a little note. Okay, he's talking about what has happened in the stock market here. Now, he's just talking about the book does not address itself to the overall financial policy of savers and investors. It only talks about the fund management aspect of it. All right, and that those funds which are placed in stocks and bonds. So it's a very clearly traditional asset management approach. So here, this actually is a useful takeoff point to highlight the difference between wealth management and asset management. So here you can see WM is wealth management, AM is asset management. You can read this. This is an interview with, it's a short, it's an excerpt from an interview with Mary Erdoes. Mary Erdoes, I don't know how exactly to pronounce that name. Let's see how the YouTube works. Load the video, it goes off, but you can load it. You can, I've given you the link. So this is an excerpt from an interview. You can watch the entire interview. So this lady is actually managing the wealth management business of JP Morgan. So she gives an example, she gives a discussion, a good explanation of what is meant by wealth management and what is the difference between wealth management and asset management. This is a broader concept, wealth management. It deals with all kinds of issues with even estate planning. You know, how do you hand over your assets to your next generation? All kinds of broader issues, and asset management is a subset of this, which deals specifically with deploying funds in the market in particular types of securities. Whereas this is much broader because it includes things like tax planning, estate planning, you know, how you organize your businesses and all those things, and all the other aspects of wealth management. So this is why, so this is the difference. It's important to know this difference because this is also a big growing sector of the financial services industry. And you can try for some jobs in, we have many new firms that have come up, like IIFL Wealth Management. It's quite a big success story in the Indian markets. So there are many companies, also other companies, smaller companies trying to repeat that kind of success. So this wealth management is a booming sector. So you need to know this basic difference between wealth management and asset management. So we'll shut this off now. All right. So this is basically saying that in this book we are only talking about asset management, and that too a very traditional type of asset management, looking only at bonds and stocks, not looking at currencies or commodities or real estate, which are also legitimate avenues for investment. Okay, so other things like where they don't discuss all this. Okay. This is basically the point. Then you have commentary on the introduction. Here I have nothing really to add. We'll just go through the commentary. This, other than this book which I've mentioned to you before, you can read up this. You can find the audio book on YouTube, and you can find the book on the internet. It's a useful book to read, and I think I put it in. I might have even put it into your reference list in the project guide. Okay, so let's just quickly go through this and see what he's talking about. He's just summarizing. This is the commentary on the introduction. So it's really repetition because he's just summarizing what Graham has already said. All right. Remember this, that once you lose a certain percentage, you have to make a much higher percentage to get back because the base is lower now, right? So what is meant by intelligence here? Intelligent is actually should be replaced by the word disciplined, and it's really more about discipline than anything else. So he's talked about some of these cases like 98 LTCM, which I've discussed with you before. It had two Nobel laureates in economics, but they lost a lot of money because they didn't really understand how markets operate in the real world, and so they failed to understand that, and lost a lot of money, and eventually they had to be rescued. The Federal Reserve had to step in. And here again, so these are all examples of how people did not apply simple common sense, and they were not disciplined in the way that they were investing or playing in the market. So the story of Isaac Newton. How Isaac Newton, being one of the most intelligent people, but was not an intelligent investor because he failed to be disciplined. He he could not control himself and reinvested and lost money. So basically, it's a lot about applying of being a disciplined investor and being able to keep your emotions in check and stick to the plan. The major financial developments, you can just go through that. There's not much to talk about here. You can just read through this, but read all this because for you it's all new knowledge, and you should have a sense of how U.S. markets have behaved and what are the major issues in the U.S. markets, because they are still the biggest markets in the world, biggest and most liquid markets in the world. So you should have a sense of how they behave or how they have behaved, even historically, what happened in the U.S. market. This is important for you to know. Yeah. He's basically saying that all things could have been avoided. And he's given all these, so I'm not going to spend too much time on this. These are all examples of how people got carried away. He's giving all examples of how people got carried away by their short-term performance and started predicting that this would get repeated in the future. But that's not how it works because there's no guarantee. Many of the investment fund prospectus notes, if you see, they will always mention that past performance is no guarantee of future returns. Right. So this is something that you have to mention in this. Maybe we can mention this on page 30 as something So this you will see past performance does not guarantee future returns. Um, you will see this mostly mentioned in front prospectuses. Okay, this kind of language is very common to show you that to basically cover themselves for the legal risk that so avoiding the risk that they be seen as suggesting that they can repeat their past performance, but they always that's why they always have this kind of a line in the fund prospectus saying that past performance does not guarantee future returns. So these are all examples of what happened, how people got carried away by their how people got carried away by their past performance. Yeah, you'll find experts who appear on TV and essentially say that, oh, this is going to happen. So the most important thing to understand is about markets is the high level of uncertainty. No matter how much research you do, and someone who did not do that much research could be right. So this is one of the unpredictable things about investing because the market is so uncertain. It is not a feature of other professions. If you see, as a fund manager, you may do a lot of research and you may be very disciplined and all that, but you still may not do well because the market is quite erratic and there's no way to predict how it's going to behave. On the other hand, if you're, let's say, if you're a lawyer or an accountant and you do work for clients, I mean, you can bill them by the hour. So if you put in 20 hours of work, you will get paid for 20 hours. In the fund management business, it's very different because it's quite unforgiving and quite harsh in that sense compared to other professions like doctors. You do work and you operate on the patient. Even if the patient dies, you still get paid. You treat somebody or the patient doesn't get well, you still get paid. So all these other professions are much more reasonable in the sense that you put in some solid effort, you can expect to get a return. But in investing, it's much more uncertain. Even very well-known funds and very well-established funds eventually go. Very often they go into bad patches, rough patches. So it's very, very uncertain. So I guess the rewards are also a little bit on the outsides. Rewards are also disproportionate. So it kind of covers for the risk, right? He's talking about here how the market swings between hope and despair, very high, very optimistic state of affairs, then very pessimistic state of affairs. So this chapter 8, which is quite famous in this for this book, chapter 8 of intelligent of this book is quite famous, right? And this is where he how he's talked about how you should actually control your. A lot of the time when Yeah. So the first thing to note is what I've mentioned here is that uh, it's not a precise distinction. Okay, like unlike for instance between from an accounting point of view, from distinction between intangible assets or the accounting definition of goodwill, it's very precise. Now you may agree, you may argue like Mayank has argued that this is not really correct, that you should not leave out intangible patents and copyrights, intellectual property assets. So, and he's correct from an economic perspective. But it does not change the fact that the accounting definition of goodwill is highly precise. It's a mathematical definition. So, this, in that sense, this thing that he keeps talking about, investors versus speculators, it's not really precise because let's look at it. And this is also an important thing for you to understand, to see, to be aware of all these kinds of discussions, because these types of discussions are quite common in the market. So what you have to look out for is when you're listening to people talking about the market is, are they talking in a highly precise manner? Like what is a money market security, that it has to have it has to be issued at a discount to face value, can't have a coupon, then it has to have an initial maturity less than equal to 1 year. And if it doesn't meet any of these tests, then it has to be a bond market security. Okay, so the distinction between money markets and bond markets. But these are very precise distinctions. There's no confusion at all. You can always apply the test and come up with a clear-cut answer. Well, one. Yeah, I'll just keep you guys for a little bit longer, not too much, okay, because it's not really your fault. It's I just want to cover this one point at least before we finish. Okay, so that he's referring you to this book, Security Analysis, is also very important, which you should read. Okay, let's look at this definition here. Investment operation or distinction. Thorough analysis promises safety of principle and an adequate. Okay, and so thorough analysis promises. Okay, thorough analysis is a subjective word. Promises safety of principle. Who cares if it promises safety or the promise doesn't mean anything? I mean, there is no promising, nobody should be making promises about anything because the future is completely uncertain. And not adequate return, which is based on the promise of safety. I mean, the same thing, which is adequate return. How do you know you're going to get an adequate return? You don't have any basis for saying that. Just because you did some analysis, that doesn't mean anything because the market is so erratic. So these things are actually, this is what I call problematic. It's amazing that a guy like Graham has given this kind of a definition. These are not precise definitions, thorough analysis. highly subjective. Promises safety of principle. Nobody is in a position to promise anything. Nobody should be promising anything because nobody has any basis for promising anything. An adequate return. None of this is being escaped. Nobody. There's no basis for talking about any of this stuff. Yeah. So the basic problem. Investment operation. I'll just let you go in a minute, okay? Investment operation is subjective, and you've understood why it's. This is also an important point to understand that you should develop this instinct and this ability to distinguish between warm and fuzzy, loose, subjective definitions versus highly precise definitions, which are objective. So this thing is an important learning because you'll find this problem throughout in finance. All right. So I've taken 3 minutes, 18 seconds of your time. So the class is dismissed. Okay. Those who have questions can stay back, and those others can go. I'm sorry. I'm very sorry about the connection quality today. Let me investigate this and see if I can make out something. But hopefully, the notes. If you study the notes, I've tried to write the notes in a precise enough and detailed enough manner so you can still extract the learning, and then I'll upload the video and we'll see how good or bad the video is. Okay, so you'll also get the video before I upload it in the stream itself. I mean, we'll see how bad it is in terms of the interruptions. Okay, so you guys can leave, and anybody with a question can ask.
Sir, am I audible?
Yeah, sorry, Mayank.
Yes, sir.
Yeah, Mayank, can you hear me?
Sir, I can hear you, but voice is coming and going. So no issues. I will ask in the next class.
That's okay. Try now. Try and see what happens. Just if you can quickly tell us your question.
Yes, sir. Sir, like in last class, we saw that U.S. Treasury bills, right? So it was like coming out 1.33%. So my just basic question is this
That's
only
a
that
10 year
yes,
10-year US Treasury note. That's not a bill,
yes,
okay? That's a
yes,
10-year
sir.
US Treasury note.
Yeah,
You have to be precise in your words.
Treasury
Okay.
notes. Yes, sir.
Yeah.
So
So go ahead.
why a
Yeah.
person will
Yeah.
be investing in that note of that is like 1.33% only, but like if we see in India only the uh, FD rates are much FD nahi, even basic interest rates are much higher in banks. So why a person will invest in those bills?
Yeah. Sorry. I lost much of it. I guess it makes more sense. You just we'll see, and hopefully we have a little better connection the next day, which is we are meeting on Friday on Saturday, right?
Chatter.
Yeah, meeting on Saturday. Yeah. So yeah, you I got some of it that why should a person be happy with that kind of rate, something like that you were saying. When in India you can get a higher rate, etc. That's kind
Ye-
of something like what you were saying, right? But that's depends on, and see in India if you are investing in India, if depends on that relates to you have to think about the what is your base currency as an investor. I think too because I couldn't hear the full question, it got cut off. But I think if I understood you correctly, this is what you're asking. Why should we accept something like 1.33% when you can get a higher rate in India, Indian government bonds, etc.?
Not even in India, sir, even in USA also. I think the inflation would be much higher than 1.33%.
Yeah. So you have to look at the risk. You're talking about higher return on assets. So the return has to be looked at in correlation to the risk. You have to see the risk and return analysis. You have to see the risk and return in comparison. So you could, for instance, obviously you will get a higher rate on a HDFC Bank US dollar bond than you will get on a 10-year US Treasury note. But then the risk of the HDFC Bank bond is much higher. Okay, so you have to assess whether the extra return is making up for the risk. So since we are not hold, yeah. And there is another element to this one, Mayank. With another element is you have to first look at the risk also, not just the return. And the second is you have to, in order to understand the true nature of the risk, you have to look at your base currency as an investor. Your base currency, like if you're operating, if say so Aditya is investing from India in US Treasuries, he's actually a rupee based investor. So if there is some fluctuation in the dollar rupee rate, it will affect his return. So he has to think about the currency risk as well. So it's not just so he Aditya might buy some junk bonds issued by Evergrande Asset Management, which is a Chinese company which is now on the brink of bankruptcy. So Aditya might have bought some dollar bonds issued by Evergrande. So he has taken not just the default risk of credit risk of that company, but he has also taken the currency risk of the dollar rupee exchange rate, because what might happen is after he has invested, he would have sold his rupees and bought some dollars, then used those dollars to buy the Evergrande bonds. Then after that, what might have happened is that the dollar rupee rate might have actually gone down, which is the dollar would have weakened against the rupee. So now Aditya will have a loss on his currency exchange also. Once he gets back whatever money he can from Evergrande, maybe he will get back 30 cents on the dollar. So he gets back only 30% of his principal. So he gets hit by credit risk. And he also gets hit by exchange rate risk or FX risk, because when he's trying to convert his 30 cents on the dollar back to his home currency of rupees, the dollar is worth much less against the rupee. Maybe it has fallen from 76 to maybe 65. So then he's going to suffer a currency loss as well. So you have to look at two things. So yeah, so you have to look at the full picture of the risks, including the risks that arise from the home currency of the investor, which is basically the FX risk. Is this were you able to pick up most of what I said? Uh,
Yes, yes, sir. But again, the thing is this only, that even the inflation means at 1.33%, the money is already at risk only, because that more than that would be the inflation rate only per year. So money is already depreciating in the value.
to invest in US Treasuries for 10 years for 1.33% return. But the fact remains that, and your point is absolutely correct from a logical point of view, but the market is not logical. So you can't also, I mean, at the end of the day, the market is king. So the market's pricing of something is very important, because at the end of the day, all your profits and losses are made based on what the market is pricing. So you may buy a stock based on, you might buy ExxonMobil at $20 because you think the fair value is $60. But until the market agrees with your assessment, you're not going to make any money. So the most important thing to understand is that the market is king. It doesn't make sense maybe a lot of the time, but who cares? I mean, the market is king. The market doesn't have to make sense.
Okay. Okay,
You're
sir.
not, you understand what I'm saying? There's some basic
Yes.
idea you have now, yeah, right?
Yes, sir. Yes.
So the market is king. All right. Okay, so you have some sense of okay on based on what. Anybody else? Let's try our best at least. Maybe it's still giving me problems actually. Yeah. Okay. So I'm ending it. That yeah. Always remember that it's your duty to look at the notes and see if there's anything that you don't understand. Then you have to tell me, and then I will write out the notes in greater detail so that you're able to understand. Unless you tell me I can't figure out, I try to put myself in your shoes and write it as clearly as possible. But if there is any further clarification required, you have to inform me that I'm not able to follow this part, and then I will write it in greater detail. All right. Okay. So once again, my apologies for the quality of the connection. Let me see what I can do about it, and hopefully we have a better experience on Saturday. All right. So we'll just end this. So I'm ending the session now.